Money at Work Continuing Education Series. Today's episode centers around the relationship between interest rates and bonds and how higher interest rates will pressure bond prices. So interest rates have an inverse relationship with bond prices. The way bond prices are actually calculated can be a little bit awkward. However, even if you have not purchased a single bond in your portfolio, it's still good to learn and understand how they work and how the prices are calculated. Why do bond prices change with interest rates? When interest rates rise, bond prices fall. Vice versa, when interest rates go lower, bond prices increase. It's really that easy to understand the basic concept and inverse relationship. So why is it that if interest rates rise and bond prices fall, and when interest rates fall, bond prices rise? That's because when interest rates rise, investors can get a better return elsewhere. So that price of the original bond adjusts downward to yield at the current rate. Think of it as an adjustment to the interest rate itself. Stocks versus bonds. So unlike stocks where you own a piece of the company, bonds are a type of loan made by an investor, so you own some of the debt that the company owes. Many times the loan is to a company or a government agency. In return, the investor receives fixed rate interest income, which remains the same despite how market interest rates might change. So if the interest rate is fixed, you can see how the bond price would need to adjust to changes in the interest rates. Bond competition. Bonds compete against one another on the interest income they provide to the end investor. When interest rates go up, there are new issue bonds coming out with higher rates, which provide more income. On the other hand, when interest rates go down, new bonds issued have a lower rate and aren't as tempting as the older existing bonds. As a result, the only way to increase competitiveness and attract new investors is to reduce that bond price to adjust to the market. As a result, the original bondholder now has an asset that is worth less than they originally paid for. Also, it does not pay out as much as the new issue bonds coming into the marketplace. So do you buy bonds when interest rates start rising? Well, interest rates will always change, and no one can predict how they'll change over extended time periods. Bond pricing can be complex, so make sure you understand what you're buying, why you're buying it, what you are receiving in return, or better yet, consider working with a financial advisor. They can help run the numbers and figure out whether a bond purchase is fit for your goals at this time. Remember, bonds can be an important part of an overall portfolio. It always helps to know how interest rates affect their prices so you can adjust your portfolio or your holdings when interest rates change. The information in this video is for educational purposes only and is in no way tax, investment, or financial advice. Investing in bonds in this situation involves risk, including the possible loss of principal. Millionaire Mindset.life. Stretch your thinking, create your vision, and achieve.